Hello and welcome to Money, 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 your weekly personal finance date with me, Sumaira Abdi. You know, when we're dealing with money, it's easy to get overwhelmed because for most of us, finding that right mix between earning, saving, spending and investing can take some time. But help is at hand. It is easy to keep it simple. Financial minimalism is possible, and even better, simplifying your financial life can actually reap major benefits. So helping us do just that and to declutter our finances is Mohit Gang, CEO and co-founder of Moneyfront. Hi Mohit, thanks very much for joining in. But you know, the problem with keeping it simple is that a lot of people feel that, they haven't done enough, right? So how do you debunk the myth that simple is not enough?
Hi, Sumaira. Always a pleasure to be on your show. So look, I'll just start by quoting Paul Samuelson out here, and he says that investing is like watching grass grow or watching paint dry. If you really want excitement in your life, then you take $1,000 and go to Las Vegas, right? And that's honestly the whole philosophy of investments. The more simple you keep it, the more boring it gets, the better it will be for you in the long run, right? And I think that's where the beauty lies, that if you really try and make it very complex, very exotic, you try and mix and do a lot of things, try and chop and churn, it becomes extremely meaningless and you end up losing money or end up paying high costs. So just keep it simple, keep it boring, and just let it grow by itself. That's the whole fundamental rule out there.
But is it enough? I mean, will it get you where you want to go?
Oh, definitely. Look, I think if you just don't touch, and most of the times, if you realize the investments which you have not touched for many years are the ones which will give you the largest amount of benefit. The compounding impact of those investments is massive, right? If you just keep it, let's say if you know your own abilities, if you know you're not the one who will sit in front of the screen day in and day out, who will track stocks, who understand cash flows, who understand balance sheets, who can't differentiate between return on equity and return on capital employed, then there is no point getting into stock markets. Just for an example, right? You are rather better off staying investing in a simple product like a mutual fund and staying the course for 10, 15, 20 years. They'll yield you higher results because the chances of you making mistakes are that much lower in this case.
Okay. But for a lot of people, what happens is that, we start off on our investment journey. We'll have our, the SIPs that we have set up, they go out. We may have some EMIs that are going out. But beyond that, if there is money coming in, we let our bank account sort of just keep building up, right? Is that healthy? I mean, that's keeping it simple, but does it work?
Okay, look, so out here, I think the end objective, Sumera, is that you have to cross the swamp and you have to not fight the crocodiles, right? Which is, again, going back to your first question, that you don't have to like really make it very exotic, but keeping cash for your emergency requirements, to me, is the most fundamental thing of personal finance, right? And many times you would find experts debating whether you should keep it in liquid or money market instruments or some FDs or something like that. But to me, that 6 months of confidence, which a cash balance in the bank account gives, is much more than anything else, right? So a 6 months to a 12-month kind of an emergency corpus kept simply in savings account or a sweep in FD, right? If you can do a sweep in FD, nothing like it. That's the best instrument available out there. But just plain simple cash also in the savings account for 6 months kind of an emergency is a good confidence booster and should be there.
Okay. And of course, having insurance would add to that comfort, right? But how do you sort of structure your insurance portfolio in a way that
of instruments which are available within that overall ambit of insurance is much more complex. The first fundamental rule is just do term insurance, plain vanilla life cover. Never go for anything exotic in insurance which is linked to investments or which is linked to some goals or which is some structure which gives you some bonus or something like that, right? So just keep it very simple, plain vanilla life cover. That's rule number one. Rule number two, Sumaira, is that you need not buy a very huge insurance policy. I really differ with many advisors out here who advocate a huge cover. They will compute your personal liabilities, your family liabilities, your outstanding loans, your financial goals, and club the entire amount and make you buy a 2 crore, 5 crore, 10 crore policy. To me, you have to break it into 2 or 3 components. You have to define it goal wise. So if you have a goal, let's say for me, I have a goal for my daughter's education and her marriage. which is 15-20 years down the line, I will buy, and I know X amount is required for that. So I'll buy just one policy with X amount, which is, let's say, a crore kind of an amount for 20 years. That's about it. Once that goal is achieved, and if I live till then I don't have to save further for that, and I'll close that policy. I'll not keep paying that sinking premium every year. Second, my retirement goal. Now, simultaneously, I'm building an asset cover for that. I'm doing my SIPs, I'm doing my other investments to build a retirement corpus for myself, right? And if I think by the age of retirement, I have a sufficient enough asset cover, then I need not continue to pay for insurance. If I build a huge asset base for myself, then insurance actually doesn't serve much purpose after a particular asset base which you wanted to build in the first place. So you can forego that policy. So the right way is to ladder out your insurance, buy 2 or 3 policies, keep closing as you cover those financial goals, and just perhaps keep one ticking along to cover for any eventuality and give some support, financial support to your family and your near and dear ones in case there is any eventuality. But yeah, buying a huge policy doesn't work well for me.
Okay, no, that's an interesting point of view, and you have presented your argument as very well as well. But this is life cover, right? Health insurance is still something that we need to buy.
Oh yeah, definitely. That there's no compromise out there, and I think again the whole thing is people tend to take this thing very easy, which is a basic health cover. Now that is one cost which is not growing at the inflation rate, which is the health medical care cost is just not growing at 5-7%, is exponentially growing. It's growing at 10, 12, 15, 20% kind of this thing. So it is getting prohibitive. Now, 2 things out here. Every employer provides you a medical cover. If you are an employee, if you're a salaried guy, you're getting an employee cover, but you will keep changing jobs. You will not end up at the same place at your retirement and when you started your career. So you will change 2 or 3 jobs and your medical cover will also keep changing, right? And when you need it the most, which is near the retirement age, that's the time when you will lose it if you rely on your employer. So the whole thing is, quickly take a medical cover in your own personal capacity, a personal name, and that could be a family floater to start with, basically, which will keep accruing no claim bonus for you till you retire, and which will be your own policy, which carries on for the life of yours, right? So that's the most important and essential part, to have a medical cover on your own name.
Okay, fair enough. But, one problem that arises, and here is where things get complicated for most people, is when we spend more than we should, right? So I know there is this 50-30 rule about how you should divide the money that you have. But does this rule still hold? I mean, it's been, decades since somebody has thought of updoing it. So is it time to look at revising this rule, or will 50-30-20 is still a good sort of allocation for people here?
Like for starters, honestly, Sumaira, I think it works really well, right? It's a broad thumb rule. Obviously, it can't be like pasted on each and every individual, because everyone has their own personal, criterias or personal obligations in life to fulfill. So it has to be tweaked accordingly. But as a thumb rule, it works really well. However, I have a tweak to that. You start your career, or you start your earning career or your saving career with this rule, which is 50% for your discretionary 50% for your necessary expenses, which is your daily bread and butter, which is your food, your EMIs, your compulsory expenses, your rents, your bills, electricity, mobile, etc., right? 30% is your discretionary and your lifestyle expenses, which is the way you shop, your restaurants, your clubbing expenses, so on and so forth. And 20% compulsorily has to go to investments, which is called in personal finance language, it's called paying yourself first, right? So you pay yourself first, which is you give 20% to your own corpus building, wealth creation, retirement goals, and you keep it aside for investments. But the whole thing is, you don't keep this formula static. You keep moving the needle with every passing age or decade in your age, right? So it has to keep moving. And by the time you turn 50, the formula has to completely reverse, which means at age 50, 50% of your earnings has to go for savings and investments. 30% continues to be your discretionary and lifestyle expenses, and only 20% for your daily household needs, right? The whole assumption out here is your salary or your earnings would have increased many folds by the time you reach 50. And the overall amount allocation required for your household expenses won't increase that much in absolute sense, right? So 20% would suffice by then. And a major chunk of your savings should then go for investments to build a good retirement corpus for yourself. So it has to be a dynamic moving formula is what I call it.
All right, fair enough. And keep increasing or stepping up your investments as you go along. We're going to take a very quick break, but this is an interesting chat. Mohit has some more hacks for us on the other side. So we'll continue our conversation about how to simplify our financial life. Stay tuned. Hi, welcome back. You're watching Money, 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 and with us we have Mohit Gang, who's the CEO and co-founder of Moneyfront, and today we're talking about how to declutter or how to simplify our financial life and whether or not it can reap benefits. So we've already spoken about how simple too can get you results, and we have some more hacks. But one of the things which Mohit proves to be a big headache for people is that, when they have outstanding loans, right? So how does one plan to sort of cut debt in a meaningful way that, you don't sort of end up, sacrificing everything else, plus you don't have sleepless nights because you have debt outstanding?
Right. Look, I think Sumaira, most of us start our lives in negative, our earning careers in negative, which I mean to say is we start by paying off our educational loans, which we would have picked up for our higher education, so on and so forth, right? There are very few fortunate ones who start life with a zero base or with a positive base, as in the earning career. So everyone has to go through this cycle of debt. Now, look, debt is bad, but all debt is not bad. Debt which is useful is the one which you take for building, which is more like towards a capex or capital expenditure, which is more like building an asset. So for your education, it's like building an asset which repays you back throughout your earning career, right? Or you buy a house. It's a capital expenditure. It's more for your peace of mind and stability and so on and so forth, right? So you have to pick up those debts sometimes in your life. Debt which is bad is the one which you pick up for discretionary things, which you pick up for your lifestyle, which you pick up, let's say, to travel, you want to, or you pick up for your personal shopping, or you pick up those debts on your credit cards and your personal loans and so on and so forth. Those are blasphemous, honestly. Anything in debt which is above 9%. Now, again, this is not a thumb rule. It will change with time and era, with interest rates and so on and so forth. But broadly speaking, anything which is over 9% to me is poisonous, right? And those personal loans debts, which are at around 12, 14, 16, 18%, those are obnoxious. So one has to be very careful why he's picking up debt. If it is for building an asset, then please, more than welcome, go ahead and pick it, but don't pick it beyond your paying capacity, which means that within that 50, 30, 20 rule, you should not over allocate, and that 50 should not be stretching and eating up into your investment corpus, basically. So the debt EMI has to settle within that 50 plus 30, 80 rupees component of your saving habits, right? And anything which is beyond that rate, or which is a credit card or a personal loan, should be clearly avoided, right? And that's more about on debt.
Okay. What about Provident Fund? I know you recommend it. Does it move the needle enough?
Oh, look, I've been, for all my 20 years in this investing business, I've been a big advocate of personal PF and PPF, basically. To me, a rate of 8% tax-free is godsend. Honestly, it's like 12% pre-tax, basically, which is what most of us take our assumptions in building equity portfolios to start with, right? So if you're getting that for the life of yours and with a sovereign guarantee, there's nothing which can beat the comfort and the economy of it, right? And the whole good part is, Sumaira, your earning career or your salaried career will be, let's say, 35 years, from age 25 to age 60. You will not even realize that saving in that PF with that kind of an interest rate, it creates magic with compounding. For a 35 long years, the whole corpus which you accumulate will be huge and massive and will be a big support system for your retirement. So that's personally a retirement corpus. Similarly, PPF, though only 1.5 lakh rupees is allowed per individual per financial year, but I think if you keep making that contribution, rates again currently are 7, but at a long term you can very well assume that it will hover between 7 to 8, basically, right? Tax-free rate again is massive. Right. And the kind of corpus which you build through these instruments, you don't realize it. It keeps building at the back of it. And because it is not in front of your eyes, you don't tend to dabble in it and don't tend to withdraw it. One ground rule here is when a person changes his or her job, you should not withdraw the PF. Please. I think that's the most, that's the biggest error I have seen in my personal career, that people, when they switch jobs or hop jobs, they withdraw their PF and then start afresh with the new job. That's wrong. You should transfer your PF, please, and let it accumulate behind and see the power of compounding.
Absolutely. I'm glad you mentioned compounding, because, you know, over time, if we allow it to happen, it can really add up, right?
Oh, totally. I think it's not without a reason that you called it the eighth wonder of the world, right? And very simply speaking, human brains are not wired to do geometric progression. Human brains are wired only for arithmetical calculations. And just to simplify, what I'm trying and saying out here is that if I were to ask you what is 6 plus 6 plus 6 plus 6, you will keep answering and it can keep going on. But if I ask you what is 6 into 6 into 6 into 6, perhaps each one of us will fail at the third or the fourth level, right? So that's geometric, because our brains are not wired to think in a multiplicative way. We can't understand the implications of compounding. But if you leave your investments untouched, if you leave it for years put together, the economy of it and the rate at which it will grow for you is magic. And Sumera, I was seeing one of your Instagram videos recently where you said 1 rupee every day for 30 days, or you'll prefer 5 crore upfront, right? And you so clearly got out the benefit of compounding. So I think those are smaller things which people should appreciate, that they should just leave their investments and not try and tinker around with it on a daily basis.
Yeah, if at all, like you have suggested, maintain a small tactical portfolio, right, which you can sort of use to, what can I say, use to take more risky bets?
Oh, yeah, totally. So look, I think for investors, what we personally advise is you go with 90 rupees of strategic allocation and 10 rupees of tactical, which I broad framework for it. Basically 70 out of it, which is 70% of that 90 should go into equities. 30% of that 90, the remaining 30 has to be divided between debt and gold to some extent. I personally believe in preserving some amount with gold also. So 10% in gold and 20% in debt. But this is not a fixed criteria for everyone. It will change as per your personal circumstances and your personal liabilities and so on and so forth. But this is a very broad framework. The 10 rupees of tactical allocation, again, as I said, is your play money. You can just go out there and try some trading punts or try whatever new products you want to gamble with. If it plays well, keep playing with it, but don't mix the two pots. Basically, that's the whole thing. You can't interchange the two pots, which means if you're losing money in tactical pot, you should not withdraw from your strategic pot and move it to tactical. And if your tactical money keeps growing, let that pot increase and just keep increasing that, but keep these two separate bank accounts, two separate demat accounts, or whatever you want to call it, but keep these two pots separately and run it separately.
Okay. And just one final question, Mohit, because, you know, we spend so much time discussing what to do that sometimes we forget what not to do. So what's in your not to do list?
Sumera, look, I am a big fan of Roger Federer, and I can't stay away from commenting about him. I keep Roger Federer right behind me every time, basically. So 25 years of career is not built without avoiding mistakes, right? You have to stay fit through the course, and you have to avoid making mistakes. Same with investments. If you want to run your journey for 25, 30, 35 years, you have to avoid mistakes. You have to avoid high cost products. You have to avoid exotic products. You have to avoid insurance, which is linked with investments. That's the most blasphemous product I've ever seen in my life, basically. And you have to avoid anything which is complex. If you can't understand it, if it is too good to be true, it definitely is too good to be true. So just avoid it. The more you avoid, just keep avoiding everything. Just stay put with very basic, simple products which you can understand: your PF, your EPF, your PPF, your mutual funds, your SIPs, small amount of stock portfolio which you're very confident of. And that's about it. It will make a whole lot of money for you if you stop avoiding these, stop tinkering around with it, and keep at it for 25, 30 years of your life. Avoid these mistakes, and you will have the greatest compounding benefit one can ever reap, and a huge corpus for your good and healthy retirement.
All right, Mohit, thanks very much for joining in with these great insights. So, keeping it simple is not always, unfruitful. Boring can actually get you the results that you desire. With that, we'll wind up on this edition of Money, Money, Money. Thanks very much for watching, and we'll see you again next week.